Welcome to Property Developers Question Time, The Conversation. I'm joined today by Nicholas Wallwork, CEO of Property Forum and author of Investing in International Real Estate for Dummies, and Rod Turner, owner of ITP Group. Today we're going to be talking about raising equity and raising profile. And my first question today will go to you, Nicholas. What are the options for raising equity in property development projects and how do they work?
Well, there's a few different ways. In our development side to our business, we work with high net worth individuals and small family offices from time to time, raising private equity. There are other methods like crowdfunding and various different creative finance solutions coming out. And I think there are different crowdfunders that operate slightly differently. Some take equity stakes, some just purely fund at a certain interest rate. And there are also creative finances out there that are ultra high net worth individuals, we call them, and they actually do sort of a JV setup. So that I think, the word JV, joint venture, is also another way of raising finance. Depends on the structure and the organisational person, but you might have to give away a little bit more there of the equity side, but you might get the finance cheaper. So it sort of swings and roundabouts about your risk.
So just breaking this down, when you're working with high net worth individuals, are you generally working with one investor or a group of investors?
We personally work with a group of investors. So we would have a sort of lowish entry level, still sort of £25,000 entry level. So we're not talking, a few £1,000s. So I think crowdfunding is generally a lot more individuals. When you start working with private individuals, the sort of entry level sort of goes up because it's a bit of paperwork to do. You've got to raise a certain amount of money. Then we don't want to be working as a developer on that side. We don't want to be working with hundreds of investors. It would be unviable for us to do so. It would be better off then switching to working with a single crowdfunder who does the raising for us. So at the moment we raise private money in-house. It's easier.
I think that's the benefit of using it's economies of scale, isn't it? It's if you can get one high net worth individual to do it, you're only doing that one set of forms. It's only that one person that you're dealing with.
One legal fees.
But it's that one what's the word I'm looking for? Relationship that you're managing really. Whereas if you've got multiple investors, it's multiple relationships to manage. And although we can hopefully we're good at managing relationships, what our skill really is within that deal and the development. So it's always, from my point of view, much easier if I can get one high net worth individual to invest in that equity, or whether it's even debt or mezzanine finance or whatever it is. For me, that makes things easier.
It's quite interesting actually, this breakdown of approaches, and I want to come back to how you work with groups of investors in just a minute, but I think there's an interesting dynamic that we've seen, because as you I think both know, we've crowdfunded quite a bit of equity for our development projects. In fact, we've crowdfunded almost £2 million worth of equity or bond investment for our projects in the last couple of years. The difference in the dynamic that I see is when you're working with a single individual, or say a private equity fund or a family office, then you're in a relationship where that individual or that entity can in essence not quite dictate terms to you, but they have much more power in that relationship, because if you want their investment in the project, then what they will generally do is they'll say, we will invest on these terms, and you might negotiate a bit, but that's going to be the basis of the discussion. So in essence they're saying, these are the terms, take it or leave it.
I think that's very dependent on the deal.
It is dependent on the deal, but my point is, if you're relying on that one investor, you have to do a deal with them, or you don't do a deal.
Well, and that's about being reliant, and it's
sure.
Yeah.
The point from my perspective is that crowdfunding turns that on its head. What you do is you put an offer together, and you throw it out there to investors, and you say, these are the terms on which we're prepared to accept investment. Would you like to invest or not? And if it's attractive enough, some people might not like it, other people might. But if it's attractive enough, you'll get enough investment that you fill the deal. And so what you can end up with is a situation where you get better terms, and you end up with more control in the project as well. Whereas my experience in working with single investors is that you get the opposite. You get less control, and what you end up paying
It's an
is more.
interesting discussion, if I may, because we're the exact opposite. We operate just like a crowdfunder.
Yeah.
So we actually put together a product. We have a brochure. We've obviously got all of our track record and everything in there so people can see what we've done and what we're about. But actually, we put the terms together. It's a take it or leave it situation.
Okay.
Similar to a crowdfunding platform.
So
This is the investment.
You put an investment memorandum together, and so are you FCA
Absolutely.
regulated?
We're not. We raise our money on a loan note structure, which is not FCA regulated.
Okay.
It's a simple loan note instrument, like a corporate loan. It is very well controlled. It is highly secure because it's all secured on the assets. In fact, their money is secured on all of the assets together in the group company. So actually, every deal is covered by their investment, and therefore the risk is lower.
So that's what you're raising there is debt.
Not really, because it's in the header company.
Right,
It is essentially equity. Then on the individual SPVs that the group company owns, we can also raise debt as well.
Yeah.
And then this essentially forms the little piece of equity in each of the SPVs.
So in a way, it's like a corporate bond.
It's similar, but it's a different financial instrument.
Okay.
Well, it's not even a financial instrument, it's a loan. So it has all the security and flexibility that a bond has without the overbearing regulation. It's not quite as tightly controlled, but that's a good thing for everyone. It means we can offer investors a good rate of return. That's also critical, is the lack of regulation on that. But they still have the security, so it doesn't mean they don't have security. It just means it's not a financially tradable instrument like a bond might be.
Yeah.
I think the big thing that I come up against when speaking to investors is when it comes to the security is what's the loan to value of that security?
Yeah.
Because if the security, like you said, if you've got that company structure and they're separate SPVs, what are the actual assets that they're going to have security over? And more to the point, what charge and what loan to value will that be? Because if you've got a senior debt lender that's maybe up to 60% of costs, then if you're coming in at a second charge, where do you go up to? And obviously it's about judging that risk.
Sure. Look, I mean, there are traditional debt structures, aren't there? I mean, generally senior debt goes up to 60% loan to end value. Generally, mezzanine might take you up to 75%. You've got stretch senior, which runs across the two. But I mean, you're talking more about you're really talking about loan structures rather than equity structures. And I guess in an equity structure, the only security that you have are the shares in the SPV that's doing the development. Now your structure is a little bit different, your loan note structure, and I guess we probably don't have time to go into the detail of that right now. But what I am quite interested in, because one of the other things that a crowdfunding platform does is it brings investors to you.
Does all of that work.
So, I mean, well, not all of them. I mean, you still have to bring some of your own. But
Platform, isn't it?
obviously, if you're marketing your own offers to investors, how do you find those investors?
Well, we own one of the largest property chat forums and news portals out there, propertyforum.com. So actually, we've built a long-standing expertise track record out there. We're quite well known in the industry. So we actually started by building profile first, doing our own development deals in the background. And I think, it's critical to be, from right at the beginning of your career in any industry, but in particular property, because there's not always the most honest people in property. There's let's call it a dark side. There's people out there that get half a day's training and think they can do a deal for you. So there's the not so great element to it, but I think what's key is showing your track record, showing your brand, showing you're highly ethical from the outset. If you do one wrong deal, you're dead in the water. So I think if you start from a position of ethics and brand, then essentially people will see what you're doing and want to be a part of that because you're becoming successful. So
I think you hit the nail on the head there with track record and trust. And I actually did the opposite, where we got that track record going organically, really, through building from smaller developments to larger, and then we were able to go and build that profile to then get in any investment.
To do, not say you could do.
Absolutely, yeah. Well, it's under-deliver and over-perform.
And I think there's a strong argument for that. That is essentially what I did. I started my property development business in 2002, and I pretty much did it without building any public profile at all until probably 2017. But the point is that by that point in time, I was then able to point to a significant track record, and that I think is something that somebody who'd just come into the property game a couple of years ago wouldn't be able to do.
Absolutely, and it's not just about the track record and trust, it's also very dependent on the specific deal, because like we know, all property deals are different, and the deal really is key.
Yeah, you don't want to rule out a sort of a newbie, should we say.
Yeah.
But they may have a cracking deal, but then I think if an investor's buying into that, they've got to check that person's able to deliver that deal.
Sure.
Which is, and they may well be able to. So it's not ruling out anyone. I think it's important people get into property and learn the ropes, but don't overstretch yourself. Don't be too ambitious with your first deal.
No, I agree. And I think if you're getting into a deal which is clearly beyond the scope of your experience, then the best thing to do is partner with somebody who has that experience.
Yeah, it's a good idea, good way of doing it.
Nicholas, coming back to your tie-up with, or your ownership, I guess, of propertyforum.com,
Yeah.
I mean, are there ways in which other developers can access that channel to pick up investors?
Yeah, absolutely. I mean, it's a public forum and news portal, so everyone can chat. I think I cut my teeth in my early years of my career on all the forums out there, and we have Facebook groups this day as well where chats go on. I think it's being prolific in the industry and just watching everything, being like a sponge of learning. I read all of the top entrepreneurs' books in my career, and Richard Branson's, Warren Buffett's, all the obvious ones, and all the lesser ones as well, to learn how to access good data. So I think, with Property Forum and other resources, it's just important to learn. Start with your education if you are not into property yet, and make sure you know what you're doing before you start professing that you know what you're doing. That's a dangerous combination, isn't it?
I think it's a balance, isn't it? There's a huge amount of information freely available. And you can be as prepared as you want, but at the end of the day, you can't learn to ride a bike in a classroom, and at some point, you're going to have to get in there and do it. And I think one of the problems people make, mistakes, some people make when starting out is trying to start too big, because like we know in development, things do go wrong, and if you haven't got that contingency there, whether it's build costs, whether it's time overruns, whether it's end values not living up to expectations, absolutely. So all these things can happen. So if you're doing your first development and it's £1 million one and you've got a 10% error, you might not want that. But if you do, I don't know, a £10 million one, you can still have a 10% error in that. So that's a big difference.
Yeah, and it's absolutely the case that as the developments get bigger, the amount. Okay, the amount you can make gets bigger, but the amount you can lose gets bigger as well. And also the penalty for making an error is much bigger. So, if you do a development that's maybe a couple £100,000 and it goes wrong and you lose 20 grand, well, you can probably fund that out of your own pocket. Mm-hmm. But if you do a £5 million development and you drop £500,000 on that could easily sink you. And so I think it is more important to become more risk averse as the deals get bigger. You need to be more careful because there's a lot more on the table.
And that's one way that you can get more risk averse, is by sharing that risk and sharing the reward through equity. And why it's such a great thing to when you start out as opposed to maybe debt.
Yeah. And I do think, there's an interesting, coming back, and in the second half of this program, we'll talk about raising profile and how that can impact on raising equity and working with investors. But I do think that there's a difference between working with an investor who also brings something else to the table rather than just money. Someone who brings experience and brings connections is going to offer you something quite different to an investor that just puts money into your project and is completely hands-off. And so I guess there's a difference between what you might call smart money and what you might call passive money in that respect. So we'll talk a bit more about that in the second half of the program. So thank you very much for that, and we're just going to take a quick break. Welcome back to Property Developers Question Time, the conversation. We're talking about raising profile and raising equity, and I'd like to just start by asking, do you think it's important to have a strong profile if you want to raise money from investors?
Yeah, I think it helps for sure. I think with any business, with any career, doesn't matter if it's property or another world, I think you've got to show that you're ethical. You've got to be ethical from the root of your whole career, and then that ultimately leads into your own either personal or business brand, and you've got to lead with that profile. It doesn't mean you can't raise money without it. I think you need a cracking deal and you need to show that you can deliver the site. But on the flip side, having a proven track record is, makes life a lot easier. It's a case of I've done X, Y, and Z before. This is something I've seen before and I can cope with.
Yeah, it's interesting. We've all done a lot of things and we know what we've done because it's in our heads. I think one of the things that we often struggle with as humans is we just expect everyone else to know because we know.
Yeah.
And so I think part of profile building is actually getting what you have done out there to people. It's communicating to people all of that experience you have and the track record that you have, so that they are in the same place that you are in your mind, so that they understand exactly what you have done and what you are capable of. And I do think also that if you do that properly, it involves talking about your mistakes, because we've all made mistakes and we've all done things that
and you probably learn more from the mistakes than you do from the things going well, don't you?
Exactly. And I think a property developer that says I've made no mistakes is a liar, but actually if they had made no mistakes, they would have learned nothing. They wouldn't know very much, because you're absolutely right. It's the mistakes you learn from. It's not the successes. If everything goes swimmingly well, you don't learn anything.
But also, I think it's about being human as well. Humans, we're going to make mistakes, and with that builds trust. And what you want to get across is what the mistakes were, what caused it, and what can you do next time to mitigate those errors.
Yeah, if you take no action off the back of your learning, then you'll eventually fail, catastrophically. Yeah. I think the most successful people in the world are those that overcome the success the best. The failure is the best.
Well, it's about having some grit and focus, isn't it? And to get over those little hurdles and get on to the end goal.
For me, the mantra is we all get to make mistakes, but we only get to make them once. And so I think if you don't learn from your mistakes, then you're foolish. But I think that is the whole point of experience. It allows you to have seen something that you've done before that didn't work and do a better job the next time round.
Absolutely.
I think just going back to your comment about profile and track record, one of the other things, especially that I personally find in property, especially over the last couple of years, where so much has changed in property, whether it's legislation or planning or how things are funded, is about being current as well, and then communicating that out to other people, that what worked maybe 5 years ago may not work in the same way as it does now. And I think that's quite key, especially with working with new things that are coming to the market, like we briefly touched on serviced accommodation earlier and things like that. I think that's really important too.
I think what I'm tending to see as well, and I don't know whether you guys would echo this, is that trends seem to move faster as well. And I think it's because, when I started, and I'm pretty sure when you started, and probably when you started, although you're maybe a little younger than both of us, there wasn't all the stuff flying around on the internet. You couldn't just go onto the internet and find out what other people are doing, because we didn't have social media wasn't so prolific. Social media hasn't actually been around all that long. So when I first started, there was no social media. In fact, when I first started, the internet was really still in its infancy, and so there wasn't all of these ways that you could go and find out what other people were doing. And I think that sharing of information has meant that people's strategies get transported into other places faster. So when one person starts doing HMOs, everyone starts doing. When one person starts doing serviced accommodation, it becomes a trend.
Speed to market.
Well, it's the accessibility of the information is, like you say, so quick, but that can work the other way, because it can lead people to jump into things as well and see all the benefits. And like we talked about before, sometimes it's all about trust. And if you portray this image that nothing goes wrong and it's all rosy, you're going to get a certain type of person that's going to jump on that bandwagon, which can sometimes be a get-rich-quick scheme. There's always going to be a market for that. Let's face it. Like, look back at Bitcoin, things like that, people jumping onto it. But it comes back to that trust, and I think if you want to build relationships with investors, you want them to be long-term, because you want to come out the other end of a development and do it all again with them. And that's where I think that comes into play.
I agree, and there's no doubt that if you want to succeed in property, you have to take a long-term view. You might make profits in a short time horizon, but you can never bank on that. Yeah. And that's something that I've always believed in property. You have to take the long-term view. But we've just touched on a number of times, and would like to come back to this point. Personal brand versus business brand. Which do you guys think is most important?
I mean, having a number of different businesses in the property world, everything from property development through to the property forum, and actually a media agency, Whitefinch, specifically for the property industry. I think it's important to lead as a CEO and be the leader. So I do a bit of a balance myself. I build the brands of my individual businesses, but myself being the sort of key involvement in all these different areas, I'm building my personal brand as well. And I think it's key to be transparent. I think if people know people buy from people want to associate with successful people. I think we don't want to be a faceless organisation that has all these glossy brochures that tell a pretty story. Actually get to know the person, and I think that leads to a good quality relationship with your investors and customers.
Yeah. I think we touched on it a few times now. It's all about relationships, and it's very difficult for someone to have a relationship with a business, especially if there's key roles involved. You need to have a relationship with that key role, whether it's you or whether it's someone else. Yeah. That can be kind of negotiated on.
Well, I would argue that you can't have a relationship with a business because a business doesn't exist. A business is really, in my view, an idea.
It's a collection of people.
It's a collection of people.
With an idea.
Yeah. Who the brand of the business is stuck on. Yeah. And so to that extent, you can have a relationship with the business. But actually what you're doing is you're having a relationship with a number of people that share an idea. And so I do think, personally, I think that personal brands are much more powerful than corporate brands because you can relate to that person and you can understand exactly what that person's track record is. And if that person moves on to another company, they're still going to be that same person with that same experience.
A lot of customers follow the people they have a relationship with.
Or if you get involved in another venture, people will know who you are and what you've done, and the same with you. Yeah. I mean, it's interesting, if I think about you, I don't think about your company, I think about you as the person. Course, yeah. I think about what's Rod Turner doing, what's he involved in, and the same with you, Nicholas. Yeah. I think about what's Nicholas involved in. I know that you have these companies, but they're kind of secondary to me, to the person that sits in front of it.
I think it's important to differentiate yourself in this market. Going back to the internet and the advent of all this, immediately everyone picks up on a strategy because the information's out there. Yeah. The problem with that is you've got to rise above all of the other content. Everyone's putting out content. Everyone's putting out their ideas, their successes, less their failures, but sometimes people do that as well. But you've got to rise above that content stream. So part of sort of marketing and building profile these days is about, rising to the cream of the crop, quite literally. It's getting above the sea of content that's out there. We're in a content age, aren't we?
Well, yeah, and
raising
actually,
your head above the parapet.
You
get shot down sometimes. We've got to be prepared for that.
You see some very large, successful businesses that have very strong personal brands leading them. People like Richard Branson,
absolutely,
Bill Gates at Microsoft, Elon Musk,
Warren Buffett.
These are people
Jeff
who
Bezos.
exactly, yeah. But their personal brands are much stronger than their business brands. I mean, arguably, okay, Amazon is also a strong brand, but let's say at least as strong as their business brands.
You know their names, their household names, for a reason.
Exactly. Yeah. So I think we agree. I think we agree that personal brand is important in raising profile. So just very quickly, are there any other advantages of profile raising apart from gaining investment? We've focused a little bit on or mostly on how property developers can raise equity for their projects, but what do you guys see as the other advantages, if any?
As property developers, we're looking for money to service deals. So if we can get deals from that raising of profile, that's again a fantastic thing to then put your expertise behind a specific deal, whether it's your ability to find more money, more equity to put into it, or if it's your operational expertise to get that deal over the line and develop it out. So I think that's an obvious one that springs to mind.
Yeah, I mean, it's really, really critical. I mean, the ethos of our whole business is creating win-win relationships, whether it's a B2B partner, whether it's a broker, whether it's another developer. It's specifically and especially our investors, to create a win-win situation there. And the situation is they get fantastic returns. We get slightly more flexible money than debt, which is good for us. We can be quicker to market and buy stuff, get better deals.
More control.
What did you say? More control, exactly. More timely, and you can act faster, which is speed is money, ultimately, in our industry. But then having that profile, as you say, it can bring deals, which then helps the investor as well. So I think building your own brand and your business's brand to have that profile helps in lots of different ways.
Yeah, I agree. And I think one of the advantages of being able to actually provide a lot of information about what you do online is if somebody's looking for a very specific thing, or somebody who's interested in a very specific market area, they can find out a lot about you. And what you can find is that opportunities come to you that are actually really well tailored to you. So you don't necessarily need to do a lot of work because stuff will come to you that actually fits you quite well. I mean, a lot of stuff that will come to you that's just crap also, in fact. But and so you need a filtering system to filter that stuff out. Yeah. But certainly what I have found in the profile raising that I've done in the last few years is that some really interesting opportunities come to me that I don't think I would have, well, I know I wouldn't have seen because they've come to me via social media or via, via, I guess, ways in which things that I've used to raise my profile. People have emailed me because they've seen me on Property TV, for example, and said, look, I've got a deal. Are you interested? And actually those deals, some of those deals have been quite interesting.
It's because you've built that reputation, that trust, track record that you're now communicating out to all these.
Yeah. But it's letting people know. It's the fact that it allows you to let people know at scale.
Yeah, definitely.
Guys, really interesting discussion. Thank you for that. We've come to the end of Property Developers Question Time, the conversation. Look forward to seeing you both on the next episode.
Definitely.
Thank you.
Thanks a lot.